All right, so welcome everyone to today's staff assembly Learn at Lunch. This is Investments 101, but investments in uncertain times. We are so thrilled to have our friends from WESCOM here with us today to be sharing a lot of the tips and tricks for what's going on in these uncertain, unprecedented times. So with that, I'm just going to go ahead and turn the floor over to them. Oh, before I do, a couple quick announcements that I should make sure to mention. One, we also have a Learn at Lunch tomorrow, and it's with therapy animals, not just dogs, therapy animals. I hear there's going to be a mini horse there as well. So if you're interested, I'll put the link to that one in the chat as well.
You're muted. Joy, you're muted.
Blarg. Okay, sorry about that, everyone. Okay, so thank you for coming today's Learn at Lunch with Staff Assembly. I'm Joy. I'm the VP of Programs. Yes, that's me. So we are so thrilled to have our friends at WESCOM here today with us to be sharing the Investment 101 best practices for uncertain times and all of the unprecedented things that we're in the middle of right now. So we're really excited to have them here with us. And then also, if you haven't seen yet, there is a Learn at Lunch tomorrow also with therapy animals. So if you need a little reset, stress relief tomorrow at noon, I'll drop the link in the chat. We also have a Spark campaign. It went live this week. We are so thankful to our friends at WESCOM for everything that they do to support staff assembly. If you would also like to participate in that Spark campaign, we'll drop the link in the chat for that. This week only, if you give towards the Spark campaign, you get a Bruin face mask and it's really cute. So be sure to check that out. All right, so without any further ado, I will turn it over to our friends at WESCOM.
Thank you, Joy. Good afternoon, everyone. I'm glad that you're all able to join us here for today's Learn at Lunch. My name is Sal Murguia. I'm the Partner Development Representative with WESCOM Credit Union. I assist in managing our partnership with Staff Assembly. Joining me today is David Bochter. He's my colleague in the Partner Development Department. He will be monitoring the chat and he's going to assist in making sure that your questions are answered and that our two presenters will be able to answer your questions. Let me introduce our two esteemed colleagues that will be presenting this afternoon. First, let me introduce Karl Gerstenacker. He's our financial advisor with UCL at WESCOM, WESCOM's financial services, but he's the UCLA representative for WESCOM. So he is an advisor that's available to all of our UCLA members or associates with UCLA. Joining him will be in presenting our presentation today is David Jabczenski, but we will refer to him as DJ, and he is the Director of Investment Services with WESCOM Financial Services. We're excited to be here this afternoon and to present to all of you, and we welcome all of your questions, like I mentioned, and for those who participate, we will be rewarding a lucky few who will be participating with us Lunch and Learn or Learn at Lunch. So please stay tuned to the end and you'll hopefully be rewarded for your participation. Without further ado, let me just turn it over to Karl and DJ. Take it away, fellas, and have fun.
All right, well, good afternoon. Can everyone hear me okay? All right, and hopefully everyone can see our slides that we have up. Again, I'm David Jabczenski. You can refer to me as DJ. I'm the Director of Investment Services with WESCOM Financial. I've been with the organization since 2016 and been in the financial services business for 25 years. So excited to be here. We appreciate you spending your lunch with us. We have a lot of good information. We're going to spend probably about a minute on each slide, but we have about 50 slides to get through what's happening, how the market's performing, and also some strategies in this uncertain time. So let's get right to our slides here. All right. So again, here's our pictures up here. You know, our whole focus and commitment today is just to provide you with education. WESCOM is a nonprofit. We are a credit union. Our focus is to give back to our communities and provide financial literacy to everyone. So that's really our goal today. And so there's a lot of information that we want to get into. So let's get right into what's happening from a financial perspective. The markets are very volatile right now. Now, we've seen a lot of positivity in the market. We've seen some challenges, but what is happening in the past year that is causing this? Well, there's definitely a few things, and I've kind of highlighted these things in red. Number one is some political uncertainty. I know that we are past the election, but I do have a few slides to show you on what does that mean for us as individuals and as investors. I know we're all on maybe potentially different sides of the aisle, but what do we do from an investing standpoint at this point, now that we're past the election and the new year's around the corner? We're going to talk about that. Monetary policy. There's been a lot of different things that have happened this year with additional stimulus. Right now, of course, there's a little bit of gridlock that's happening in Washington. Hopefully, we'll get some sort of monetary stimulus here going into the new year, but I know that's on everyone's mind. We have passed, and of course, the government's passed some different programs this year. Is that increasing our debt? Yes, it is as a country. So what does that mean? And of course, the global pandemic is a big thing right now that's causing a lot of volatility. However, just in the past week, I think everyone has heard some of the potential good news of different organizations that are coming out with some potential vaccines that are 90%, if not 100% effective. So I know the market is watching that tremendously. So now that we're past the election, give you a couple of things to kind of think about. So what does this mean going forward? You as a personal investor, thinking about your portfolio, your family, opportunities going forward. Well, here's a couple of things to just consider. Now, it looks like, of course, Biden is going to be our president for 2021 going forward. And also we have a split Congress. So what does that mean as it relates to the markets? Well, it's kind of interesting, but stock market and the investment community actually likes a split Congress. So when the Senate and the House are split, what does that mean? That means gridlock. But that also means that the market can actually determine and decide what policies are going to actually happen and not happen. So gridlock's important because it basically provides for consistency to the market. You won't see regulations or new type of fiscal spending that's different that will conflict with the market. I think that's why we're seeing the market right now almost go to an all-time high, even though right now the market has been challenging the last 6 months here. Again, the market's thinking out 6 months. Now, take a look at this slide. So a couple things for 2021. Personal and corporate taxes, we feel that more than likely there won't be a lot of change because right now we have a split Congress. Regulations for the new year, we may see more regulations put back in place since the last administration did have a lot of different things from an executive order standpoint. Trade policy and also the Federal Reserve, we see that as a positive because right now the Federal Reserve is saying we will do anything we can to make sure we're supporting the economy. So those are some good news things for 2021. What else from an investment standpoint? So you may be thinking, okay, so we see some political new figures now that are going to be in the White House. What does that mean to me from an investor standpoint? So a couple things to think about. Typically, technology and healthcare will do well given the fact of our new climate going into 2021. Now, financial services is an interesting area, and you see kind of a red dot next to that because a couple things. We feel that interest rates will remain low, but there could be increased regulations going into the new year. But again, that's something that we will wait and see. Some positive areas to consider is real estate and utilities. We're definitely in a low interest rate environment and limited new regulation. So that is definitely good from an investing standpoint. So a couple more slides, and then I'm going to turn it over to Karl here. I think this is a great slide to take a look at because it basically takes a look at the last 10 years of the last decade of the market. We've all been through a lot, both personally and from an investing standpoint. But look at some of the things that have happened over the past decade. Now, clearly in February of 2020, that's when the global pandemic really started to hit. We did see the market come down around 33%, pretty dramatic. But we did see a rebound since then. But you take a look at all of the major pullbacks that the market continues to grind higher. Something I wanted to point out, you may have heard the term bear market. Just think of a bear market is when the S&P 500 or the stock market actually corrects more than 20%. Now, we can go back and take a look at history, but let's take a look at the history of 2020. So we did have this price war as it relates to oil, and also we did see a COVID slowdown in the market. Just a global pandemic, a lot hit us in February and March of this year. We did see the market down 34%, but what's interesting is the duration we put down for the bear market was 1 month. We saw the market rebound dramatically in February and March after that downturn, more dramatically than we've ever seen the market when it goes into a bear market. So there's definitely going to be volatility going forward, but it's just something to keep in mind. And of course, what are some things right now that are influencing the economy and of course our markets? Well, it's definitely interest rates. Again, I highlighted some of the key ones. We've seen oil prices. In fact, if you were watching the Financial Times or even the news on CNBC, oil prices actually were negative, meaning that you couldn't even take delivery. They had to pay you to take delivery of oil. And one of the reasons exactly why we're on a Zoom here, we're definitely not driving. We're social distancing, and we're using different technologies. So now what's also interesting is home prices have actually gone up due to the low rate environment. So another reason why the economy is doing what it's doing, and interest rates are at an all-time historic low. So one final slide before I turn it over to Karl, a couple of themes for 2020 and beyond. And I just put these in bullet points of things that are definitely on our mind and on all of our clients we work with as we go forward. Clearly, public health and the economy are the two biggest things that we wake up with every single day. We're hopeful about the public health side as it relates to a vaccine, and the economy is already starting to show some life after going through a very tough road over the past 6 to 7 months. We are slowly seeing emerging out of this recession. We're seeing additional jobs starting to be created, but we still have a long way to go. Now, could we see higher inflation down the road? We may. We are seeing a lot of spending this year, and that's one of the reasons why the economy is starting to get back on its feet. And again, keep in mind that more spending and more investing could drive rates higher. We're seeing the Federal Reserve, they're in the wings ready to help at any point. And also there is additional support fiscally to support what's happening. Lower for longer is what we feel rates are going to be doing. And of course, the 10-year treasury right now is still under 1%, although it's up.
David, you accidentally are on mute.
Sorry, I'm back on?
You're good.
Okay, sorry about that. Very interesting. Anyways, again, these are some of our themes for 2020 that we definitely want to have in front of us. More than glad to spend time individually if you have questions about these and how it relates to your investing future. But I want to turn over some time now to Karl to take over the next slides.
All righty, thanks, DJ. Can everybody hear me okay? Just give me a good nod. Yeah, okay, perfect. Technical stuff when it comes to Zoom, so we're all adjusting. Hopefully, if I go on mute, just let me know. Good to see everybody. Good to meet you. My name's Karl Gerstenacker. I'm a financial advisor with the credit union at WESCOM, and I cover, like Sal said, the UCLA branch as well as the Culver City branch down the street. And so what I do is I inform our members and I help our members make informed financial decisions so they can reach their goals. DJ just went over a nice overview of financial markets, kind of the risk that we take on whenever we invest at times, and how different things like geopolitical events or other events can impact markets. But what does all that mean to us, right, as individuals and as folks that are putting money away for our nest egg down the road? And so how do we actually not necessarily ignore the noise, but put together strategies so that way we can stay focused on building our nest egg and our accounts for down the road? And so that's what we're going to dive into today. There's going to be 4 different steps that we're going to dive into here through the presentation. I'm just going to read them for you guys. As you can see them here: develop a sound financial strategy, which is going to be the first one that we talk about. Assessing your investment options or understanding how different investment options work. Utilizing different tactics, right, when you're investing, whether it's with tax benefits or with certain investments that can provide other long-term benefits, and then just putting all that together in terms of what that means for you. So this next step, developing a sound financial strategy. There's 3 main things that we want to focus on when we put money to work or we invest, right? For us as individuals, when we're investing, we want to find out why, right? Why are we putting money away? Is it for retirement down the road? Is it to put money away for our kids for college costs, right? Is it to to purchase a home or purchase a rental property down the road, right? So there's different things that we invest, and those objectives are very important, because that leads into the second thing that you see here is time frame. How much time do we have until that goal comes up, right? Are we planning for retirement for 30 years down the road, 2 years down the road, right? Risk tolerance is the third thing that you see there. And again, very important to consider that, as we all have different levels of risk that we're willing to take to obtain a certain level of a return. Now, when we go to investment objectives, right, we'll kind of cover these things one by one, guys. Investment objectives, like I mentioned, there are many, many things that we could put money away for, right? It could be, again, for retirement. That type of investment strategy is going to look different than if you're planning maybe to put money away to purchase a home here in the next 3 to 5 years, right? So preservation of principal, as you see there, that's going to be when our objective is maybe shorter term, right? Or maybe we're going to need these funds that we're putting away in the near term. So we're not necessarily trying to take on a high level of risk to get a high return, right? Because we want to more so focus on preserving what we have in there. Income is another goal, right? When folks start to transition into retirement, they will turn their 403B or their 457B at work, right, into some sort of stream of income when they retire, right? So growth is another objective here. If you're planning to save for retirement and invest, and you are you're 30 years away from retiring, then the main objective is to be aggressive and grow your accounts. And then tax benefits, right? If you're in a position where you're looking for investments that will give you tax benefits, because maybe your income level is in a position where it's, kind of give you a tax headache. If you're maybe gaining certain returns, there's certain ways to invest to give you other benefits for tax purposes. Time frame, right? Very important. And by what I mean time frame here, guys, is your time horizon. When do you see yourself using this nest egg that you've been creating over the years? Again, that can look different if you're planning to purchase some, put money away for a down payment towards a home in the next 3 to 5 years, or if you're investing for the long term. It could also look different if you are going to retire in a couple months, right? That looks different in terms of how you invest and how you actually put your money to work. And risk tolerance, right? So if when we talk about risk tolerance, I always kind of like to put folks in a situation where, let's say an investment is in a situation where it loses value. At what point are you extremely uncomfortable, can't sleep at night, where you say, hey, I can't bear seeing my account go down anymore, I need to get out? That's kind of how you want to think about your risk tolerance. How much risk are we willing to take to potentially grow our account more down the road, but at the same time, understanding that, hey, in the short term, sometimes these accounts can go down. DJ a little bit ago was talking about 2020, right? In 2020, it's been a year like no other, right? I think we can all kind of agree on that. But the financial markets has reflected that, right? Earlier in the year, the stock market, like DJ was mentioning, dropped 35% within a month, from February 19th to March 23rd. But then from March 23rd up until maybe about a day or two ago, it has recovered all that and actually up from its low. It's up about 62%, the S&P 500. It's very difficult to predict that or even explain it really. But the idea is that if we're invested, it's important to understand that those type of short-term risks are involved. And so on this slide, guys, you can see there's different types of risks involved with investing, economic risk, market risk, company-specific risk. What they mean by company-specific risk is if you're investing in a particular individual stock and they're making headline news, that might affect the value of your stock on that day, right? Interest rate risk, with interest rates being as low as they are now, that definitely affects certain type of investments that are dependent on interest rates being maybe a little bit higher than what they are now. Again, right now is maybe a good time to get a loan to buy a car, maybe to buy a home for a mortgage, but maybe not the best time to have too much money kind of sitting in cash because of the low interest rate environment. On the last slide you guys saw, it said inflation risk, right? So you can go to the next one if you like, DJ. Inflation risk pretty much is illustrated on the slide here. It shows, as everybody probably knows, the cost of everything around us will go up, right? And it generally will go up 2.5%, 3% per year. Since the 2008 recession, it hasn't nearly been 3%, but it's still, again, kind of hovering around that 2.5%. And so this illustrates that, hey, over the long term, inflation really starts to play an important role in our daily lives and in the things that we buy, right? So over the long term, the same is true though with investing, right? The longer that you have and the longer that you're willing to invest, maybe the more growth that we can get out of your nest egg, and that's important to at least keep up with the cost of everything around us. We'll go to the next one here. All right, so I'll turn it over back to DJ here, and he'll kind of chime in terms of illustrating different investment types, and then I'll come back and we'll talk a little bit more about mutual funds and other types. Take it away, DJ.
Okay, thanks, Karl. Okay, so we're going to talk a little bit about your investment options, and I think again we're trying to put this all together in really 4 different steps. So we'll go to this next slide here. So on the screen, we have a couple of ideas as it relates to, okay, so what are some of my options? Now, Karl mentioned the stock market, and we have up on the screen here, of course, years ago, you could actually purchase these, individual certificates for the stock. Now, of course, most of it is held in what is called in kind in a brokerage account. But stocks or even bonds or cash alternatives, there's a lot of different ways that you can actually invest. And so just knowing and understanding what the different options are. The 2 big areas that a lot of our clients are looking at going into now is, of course, mutual funds, exchange traded funds, or even annuities. These are products that basically incorporate both stocks, bonds, real estate, international. So it puts it all together for you. But there is a ton of choices out there. And so we just wanted to highlight a few of those choices here. As Karl did mention, again, the markets had just an interesting ride from February lows to, of course, new highs that we're making now. So if we look for the last 20 years, I just want to highlight a couple of things in here. So you may be thinking, okay, so DJ, where do I actually start to put some of my money to work? Well, let's just look at 20 years, and then we're going to actually on the next slide look at the last 40 years. And I think that'll even give you a clearer picture. But what's interesting is the last 20 years, on the far left, you see what is called real estate investment trusts. Now, one of the reasons why I can tell you on the far left that they've been doing extremely well just in the last 20 years is because rates have come down. Just like high yield, they've actually benefited from falling rates. Now, if you look at the average investor, this is kind of interesting. It just shows how the average investor may only make around 2.5% per year based on the fact that a lot of times moving your money and continuing to make changes is actually not a good thing. Sometimes just putting it into a great strategy makes the most sense. So towards the middle of the slide, you're going to see a couple of options. You're going to see what is called the S&P 500. So this is the 500 largest companies within the United States. And that returned about 6.1. And then you see the 60-40 and 40-60. Basically, that is a blend. So those light blue and dark blue boxes right in the middle, that's basically a blend between stocks and bonds. And it's saying, based on that, about 5.5% is what you can safely say that you would have received over the last 20 years. Now, let me go to the next slide here. So let's even go further out. I know that was only 20 years, but what if you looked at 40 years? Now we're talking tremendous as far as the amount of time. So if we take a look at the Standard & Poor's 500, these are the 500 largest organizations in the United States. Now we're talking a double-digit return in the last 40 years. And keep in mind, we typically see these different economic cycles, whether it's the dot-com era of the early 2000s. We saw the Great Recession in 08, 09. So it seems like we go through some big adjustments in our economy every decade. But again, staying focused, staying invested is really the most important thing. Now, you may be thinking, okay, well, I want to look a little bit further at maybe some individual investments. Maybe it's an individual stock you're looking at, or some investment that basically has the ability to come up with a PE, which is typically an individual company. This just basically is a quick calculation where if there's a company you like, let's say it's Apple or Tesla or one of those organizations out there, again, we're not promoting them, we're just using that as an example. But if you take the price of those organizations and you take their earnings and you divide the two, you're going to get a PE ratio. So basically, it's just a price to earnings ratio, and it's just going to be one of the many tools that you can use to determine if that is going to be a investment that makes sense, or if it's basically too highly priced and it may be overvalued. Another area is called beta. So you may look, whether it's a Financial Times or again online, and you may see a stock's beta. Just know this: the typical stock market's beta is 1. If you basically have a stock that you're looking at investing in and it has a beta of 1, that means your stock or your investment will move in correlation to the market. If your beta is 0.5, that means that your investment is 50%, or I should say that much safer than the market. So if the market goes up 1%, you're going to go up 0.5%. If the market goes down 1%, you're going to go down 0.5%, meaning you're going to be in a more conservative investment. If the beta of your investment is 2 or 3 or even higher, that means when the market goes up, you will go up twice as much as the market, but also on the downside, you can go down twice as fast. So again, it's just a great tool to use as you're looking at different types of investments. Another option, of course, is individual bonds. So really the story here that you want to just take a look at is basically an individual bond is going to pay you interest fixed over a certain period of time. For an example, this is showing $1,000 bond. Let's say it's paying 6%. Basically, just kind of showing you that interest rates in the market and existing bonds can go up and down based on interest rates. So again, right now we're seeing the 10-year Treasury rate at under 1%. So if you went out and bought a Treasury and held it for over 10 or at least 10 years, you're going to earn just under 1% right now, dramatically low. Now, there is some other solutions you can look at as you start investing. Of course, a lot of our clients and members we work with are in savings accounts and CDs and money markets. But just understand right now that although these are great accounts, they make sense to keep money liquid for 3 to 6 months of emergency expenses. Maybe it's a broken water heater or repair to your car. It's important to make sure that you don't use a short-term vehicle to basically fund your long-term goals. So just know that they do play a role in your portfolio, but again, they should be, again, a smaller portion of your overall portfolio. And then the final slide I just want to cover before I turn it back over to Karl here. This is just showing a $20,000 investment, and it's really showing taxes and inflation. So what's important is, as they always say, it's not what you earn, but it's what you keep. And so that's very important as we sit down and we work with clients. We want to make certain that we include all the different calculations. So this individual, $20,000 investment, they earned around 3% for the year, which is around $600. Now they're in the federal income tax bracket of 32%. So just looking at after-tax return, they're going to net about $400. So if we add that to their existing balance, they're now at $20,000, call it $400. Now keep in mind, inflation, the cost of living, healthcare, all these different things continue to keep rising. So we do want to factor that in to get a real rate of return. So as you can see here, although we made 3%, we actually have a negative return. So it's something to just keep in mind as you build out your portfolio and make certain that you're including all these different calculations in there. So Karl, I'll turn it back over to you.
Sounds good. Thanks, DJ. DJ just covered, stocks, bonds, cash alternatives, like you just saw there on the previous couple screens. But we're going to dive into mutual funds and ETFs a little bit. The definition of these investment types are there, but really the way I explain it to our members and to our clients is these type of investments, these funds, first off, they're very common, right? They're very common for folks that have 403Bs, 457Bs at work, 401Ks, right? And essentially mutual funds and ETFs are investments that are like baskets, right? They're baskets of stocks and bonds, right? Other investments can be found in there as well, but primarily there's going to be stocks and bonds. Typically the way it'll work, a mutual fund or an ETF is considered more aggressive or more growth oriented if you have more stocks in it versus bonds. If you have more bonds in it, it's considered more of a stable, more conservative investment. But if you guys remember, stocks are more, historically speaking, grow more over time than bonds, right? And so the level of risk that you're willing to take does correlate with the growth. And so types of mutual funds that you'll find, and again, not necessarily just inside of your work retirement plan, but also if you invest money outside of your retirement plans at work. The way this is set up here, you can see that at the very top of this slide, you'll see the lower risk type of mutual funds will have things like, cash or money market, municipal bonds, right? Income funds are considered mutual funds with bonds inside of them. As you go lower here and you go into the more higher risk type of mutual funds, you'll see that you'll find more stocks in them, right? The more growth oriented mutual funds, maybe the ones that have performed the best over a longer period of time, will have more stocks inside of them, right? And so these are important to have an understanding of, simply because we see these, right? Most of us own these if we have any sort of retirement account through our employer. I know with the folks as employees of University of California, you guys have the UCRP, right? Your pension that you contribute to, but you also have access to 403Bs and 457Bs in which you can add funds to. This slide we'll spend just a quick sec on. If you own any sort of investments outside of your retirement account, right? If you have a stock account or mutual funds, and you sell, right? There are what are called capital gains and losses that you have to know about, right? Inside of a retirement account, this doesn't apply so much. But again, if you have investments outside of a retirement account, it does. So a short-term capital gain is considered any sort of profit that you make on an investment in which you've held the investment for 1 year or less, right? And you decide to sell. So a good example would be you own some stock. You own it for 6 months, it does very well, right? And you decide to sell it and cash out. There are going to be taxes that you would likely owe on that, and it'd be considered a short-term capital gain because it was less than a year. Those are taxed at regular income tax rates, right? Long-term just means that you kept the investment for longer than 1 year and you decide to sell it after owning it 1 year. And typically, if we go to the next slide, typically you'll see that long-term capital gains taxes are lower for the most part than regular income tax brackets. But again, your personal income does matter when it comes to what tax bracket you land in for capital gain tax treatment. So I'll leave this up here for a second, and then we can go to the next one. Yeah, if you guys want to take a look at that. Now, more specifically, right? Again, like I mentioned, generally we have more experience with mutual funds and ETFs because we have access to those in our retirement accounts through our employer, right? And so we wanted to share this slide so folks have an idea of what this upcoming year might look like regarding your contributions to your retirement plans, right? So not much changed from 2020 to 2021. The maximum amount that you can contribute to a 403B or a 457B is still $19,500, right? If you're 50 and over, they allow you what's called a catch-up contribution amount, which is $6,500. So you can actually contribute up to $26,000 here into a retirement account through your employer. The same applies if you have a 401k. IRAs are on the left-hand side. I know there's a lot of numbers on here, so if we hand out this presentation, you guys can maybe take a look at it. But again, very important. I think especially for folks that work at the University of California, you have access to a pension that you contribute to for down the road, but you also have access to these very effective long-term retirement accounts like a 403b and a 457b. Tax deferred plans, those are again your employer sponsored retirement plans, right? Those investment accounts, that's what they are. They're retirement accounts, but you have investment inside of them. You have certain tax benefits with those, right? When you contribute to those, one, the funds, any money that you contribute to those employer plans is considered deductible, right? So your contributions are deducted from your taxable income in the year that you put it in. But also, if you have well-performing investments in there, all that growth that you're receiving is tax deferred, which means that you don't have to pay taxes on any gains or dividends that you make inside of that retirement account until down the road, right? It's deferred for paying taxes down the road when we retire and start pulling money out. So this chart just shows how that aspect of a retirement account is very powerful over time, because if you have an investment account outside of a retirement account, if you have an investment outside of a retirement account and you're making gains or you're making dividends, likely you'll have to pay some taxes in that tax year. Whereas with your retirement account at work, you don't, right? So any sort of taxes that you had to have paid otherwise, you keep inside of that account and hopefully gain interest and earn more of a return on your investment over time. So another investment type that is that we help our members with and clients, and just that is very common for folks in general, are annuities. And there are many different type of annuities out there. Annuities can be used for income. They can be used to safely accumulate more interest instead of letting funds maybe sit in a savings account. They could be used to grow your money more aggressively. Really just depends, but really in essence, what an annuity is, there's many types, but what an annuity is simply a contract with a life insurance company where you get some guarantees. And essentially your funds in that particular annuity, as they grow, they also grow tax deferred, and you don't have to worry about paying any sort of income tax on any interest that you generate in there, as long as the funds stay inside of the annuity. There's three general types of annuities that help folks accumulate their nest egg. A fixed annuity is, if you guys have had a CD at the bank, it's very similar to a CD in the sense that it's a termed fixed product, meaning that you have to leave your funds in there for a certain amount of time and you receive a fixed interest rate. So you know at the very beginning what the interest rate is, and it's fixed for the time that you are committed to that particular annuity. So it's a fixed interest rate. You'll know what you get. There's no stock market volatility. It's a set interest rate. An index annuity is it still provides a safety of principal, meaning you won't lose any money due to the stock market. But the way that you earn interest is based on the performance of the stock market going up. So for example, they'll say, hey, if you open an index annuity today, we will take a look at what the value of the S&P 500 is 1 year from now, and you'll make the interest that the S&P 500 provided up to a certain amount. So if the S&P 500 went up 10%, you're only going to make 4, for example. That's the ceiling. And the reason they do that is because they protect you if the opposite happens. If the stock market goes down, they'll protect you and say, hey, you don't lose a dime, you don't participate this year. So it's an investment type that is linked somehow to the stock market, but you don't participate in any of the losses. And then a variable annuity is an investment type that similar to what you see in your 403b or your 457b, you have investment types in there that can fluctuate in value, but can also grow very well over time. And you can use a variable annuity to provide you with a lifetime income amount whenever you're ready to use that. So DJ, I will turn it over back to you, sir.
All right. Okay, so I have a few slides to go through here. We've talked a little bit about some strategies, some different options. Karl did a nice job kind of going through that. Now let's take a look at some tactics, some different things that you can actually do within your portfolio. We know all three of these are very important, so I just wanted to briefly touch on each one of them. First one is diversification. Next is asset allocation, and then of course dollar cost averaging. So we're just going to quickly touch on each one of these. So diversification, I think I'm going to go back to the old saying we all know is just not putting all your eggs in one basket. It's probably the easiest way to just understand the diversification side. We want to take a look at a lot of different parts of the market, not just one area. Perfect example is, let's say we were building a portfolio for one of you, and we were sitting down. We would definitely want to look at a lot of different areas within that portfolio. We'd want to look at large companies, small companies, dividend yielding companies, companies based outside the United States, and then low volatility funds. And these are areas that keep the portfolio very stable. Some of these work together, and some of these they do have an inverse relationship. So as one goes up, the other one goes down. But the whole purpose is just to make sure that we're diversifying in all these different what we call asset classes. Now, asset allocation is probably one of the best things that we do every time we sit down with someone. And again, not looking at an individual stock, but we're going to take a mix of everything. We're going to take the best of bonds, stocks, you name it, we're going to put it all together. And it's actually been statistically proven that this is a way to dampen the portfolio, risk, or call it fluctuation, and actually enhance your return. So let me show you the next slide here, because I think this actually sums this up. Now, I know this is a busy chart, probably reminds all of us of a Callan chart in chemistry class, but what's interesting is we do the same thing as it relates to investments. So this is basically looking back to 2005. Now, each color for each year represents a different asset class. So for an example, if we go back to 2005, it shows emerging markets in stocks as 34% return. And of course, fixed income was the worst performer. But we have this saying that sometimes yesterday's worst performer is tomorrow's best performer, and vice versa. So as you can see, every single calendar year, a different class or asset class typically would rise up to the top. And you would see some of those go to the bottom. But if you take a look at the middle, this is what I like about this chart here. It talks about asset allocation, where again, it's going to dampen the downside, but still keep you in the game to participate in the upside. So as the graph shows there, it just shows right in the middle is more than likely where you've been. And since 2005, you're looking at about a 6 to 7% return. So another strategy that many of us do, and this is a great idea, especially given the fact that if you have a 401k, a 403b, a 457, all of us hopefully are depositing money on a couple of week basis, whether it's through payroll deduction, or maybe it's just coming out of a checking or a savings account. But dollar cost averaging is so powerful, because what this example shows here is we're going to buy the same amount, $200. We're going to buy it when it's at $6, $3, $8, $4, $5. So really what's going to happen is it's going to overall lower our average price that we paid, which actually enhances our return. We're not going to worry about when the market's high or when it's low. But again, it's a great way to consistently invest. And again, dollar cost averaging is a very powerful tool. Okay, so I'm going to turn it back over to Karl, and we're going to try to put all this together now for everyone.
Yes, thanks, DJ. And I know there are, I saw some questions come in here, so we'll try to kind of go through this relatively quickly, guys, these last couple slides, so we can get to your questions before 1 p.m. So pretty much putting it all together, right? From past historical performance, one thing that I think we can all learn is that it's very, very difficult to time the market. Nobody that I know of, at least, can successfully do that. And so what does that mean? That means that we don't necessarily want to make certain decisions on our investments, right, based on simply what's going on in financial markets or headlines, right, or whatever we're seeing, whether on TV or what we read, right? It's more so like we talked about earlier in the presentation about our own personal situations, right? Long term, as you guys can see, there's a lot going on this slide, but over a long period of time, even though stocks tend to be the more volatile investment type in the short term, long term, they provided the most return on average, right? Bonds, a little more conservative, also provide a return, but less than stocks. Smoother ride, right? Not as much up and downs, but at the end of the day, lesser of a return. And then at the bottom, you see treasury bills, that's cash equivalent, right? So that's basically like a money market or a CD in the bank, right? And this, again, this is information just from historical numbers from 1995 to 2020. Interest rates are very low now, so these numbers might be a little bit different, especially with money sitting in the bank, right? Much lower interest. But nonetheless, at the end of the day, our personal objectives and our time frame and our risk tolerance is what matters most when it comes to investing for ourselves. Again, another slide just to kind of illustrate the idea that markets sometimes can be unpredictable, right? This shows 5-year time periods at different times in history where the market did very well. And then from, during the recession in 08, right, we see from 2005 to 2009, the recession fell in there somewhere. The return on investment in that 5-year period, not so great. But then following in 2015 to 2020, again, a rebound and doing well. So again, very difficult to predict short-term outcomes. That's why we invest for the long term. Kind of illustrating the point I was making, the time, the amount of time that you spend in the market or invested is at the end of the day what ends up mattering. And the reason is because if we decide to try to time the market and we pull money out of our investments and try to get back in at some sort of point, we might have just risked missing very, very good days or weeks in the market where we could have rebounded and increased the value of our accounts versus trying to time it and missing any sort of gains that occurred on those days we were out. So again, this illustrates that idea. Overcoming bad behavior. This again, just the idea that we want to focus on our goals, right, and our objectives, and try not to allow other noise to impact how we're investing, and kind of take a step back and realize, hey, if I'm investing for the long term, and there's up and downs in the market, that's okay. Long term, it will smooth out and increase again. But if we're investing for the short term, it's important to understand, hey, we probably shouldn't be taking a high level of risk anyway, right? So that's the idea there. A couple quotes here, right? Investing, I like the one at the bottom. Investing should be more like watching paint dry or watching grass grow. Investing, I think, when it comes to, you can speculate or you can decide to invest prudently for down the road. That's usually the way to go, especially to grow our nest egg for down in either in retirement or for other goals that we have. Now, different ways to actually do this, right? To actually invest. There's ways of doing it yourself, right? There's online brokerage firms that you can use and put money to work yourself, right? You could decide not to invest at all, right? Or you can work with financial professionals like us over at WESCOM. I think that concludes our part. And when it comes to the information, we want to thank you guys so much. We're going to take some questions here. But again, we want to thank you for taking some time during your lunch. And Sal, if you want to, or David, if you guys want to bring up the questions, or Sal, if you want to finish the presentation.
You know what? Let's defer to the question answers. I want that to be the priority right now. And we can, if we have time, we can tap into some of the resources that we have available. But let's do the Q&A. David, if you want to take that away.
Yeah, so we have several questions that I will share with you guys. But before I do that, I'm going to make sure to give everybody, DJ and Karl, Sal, and myself's email address in the chat, just in case we don't have the opportunity to address it. You can reach out to DJ and Karl for your technical questions, and Sal and I for your more general questions. But to start off, Karen had asked earlier what your thoughts are about buying stock contracts.
Sorry, I'm scrolling up. DJ, do you want to take that one?
Sure. So, and I'm trying to understand a little bit, maybe if there's additional insight to the question as far as, are they referring to, longer term contracts like LEAPs, or I'm just curious of the question if it was more of mutual fund based. So I don't know, David, if there was any additional insight to the question.
Hi, this is Karen. It was my
Oh,
question.
hey, Karen. Hi.
So I have a friend who's been buying contracts, I guess online through the internet. I guess focusing on individual companies. One she's been very successful with was Apple, but we haven't had a chance to get very much information from her on that. So I was wondering if you had any insight into it.
Okay, and I'm wondering if the program that your friend's involved in is the direct stock purchase program, where basically you're not going through a direct wirehouse or a brokerage firm, you're going direct.
Right.
And,
Yeah, she's going directly.
Oh, but she is. Okay. Yeah, there is different services out there that do that. And it's interesting, as you research them, some will actually charge no fees or cost to do it. And they do allow for what they call a dividend reinvestment program. Some will charge a fee depending on the company and organization. So I know there's some different firms online. What you can do is actually search the stock ticker, and then they'll decide if you can actually, of course, purchase that with no fee, or actually there may be a fee involved. And one of the things we do see some of our members that actually use that service online. And just know this, that if you decide at some point to move that to a brokerage firm or a trading platform, you can do that. I think I guess there's a couple of thoughts on it. And number one, the benefit is the low cost. But what I would say now is a lot of our financial institutions now have dropped the cost almost to zero when it comes to purchasing stock. So the nice thing is the competitive landscape now has actually dropped from a fee standpoint. So the consumer now is really in the driver's seat with different choices. But we at WESCOM are more of a full service, so we don't offer the program. But to Karen's question, they do exist online, and it may be something that you could take a look at. But again, research the stock with that online service to make sure that one is part of the program. There is some that you can only buy directly from the organization.
Thanks,
Yeah.
DJ.
Thanks for the question.
I have some other questions, but before we move on, just because I know some people may be dropping off and they want to reach out to Karl or DJ, one of the questions are, how can they reach you? I put the email in the chat, so feel free to email them. And then a general question is, they wanted to know if there was a consultation fee or any obligation to set up that appointment with you guys.
No, good question. There is no fee or cost to sit with us and do a consultation.
Thanks, guys. So the other question that we had that came in was from Laura. She said, if we invested outside of our retirement account, is it possible to roll that over to a retirement account without paying taxes on it?
Good question, Laura. So if you invest outside of your retirement account, remember that's considered a taxable investment account. So you would technically not be able to move the entire amount over to your retirement account. Remember, there's a maximum amount that we can add to our IRAs, our 403Bs, our 457Bs, right? So as long as the maximum is not exceeded, then technically you could, I guess, you could move money from a non-retirement account to a retirement account. But you'd have to, if you end up selling investments from your non-retirement account, there may be some taxes due, capital gains, things like that you'd have to consider before deciding to move that to your retirement account. And likely, if you're talking about a retirement account through your employer, likely you won't be able to do it because your contributions to your retirement accounts at work are through payroll, right? So they come out of your earnings at work. If you have an IRA outside of your employer retirement plan, that's a different story. But nonetheless, you'll still have to likely pay taxes on whatever you sell in the non-retirement account and move to your retirement account. So may not be the most tax efficient way to do it.
Earl, just to add on to that question, something just came to mind. You know, one of the things, and again, each plan is different as far as the retirement plan, but there is some plans that are out there, and we basically would have to individually check on that plan. But some plans do offer what is called an in-service withdrawal. And that's basically where you're still employed, you're still working away, you're still making contributions, but you're allowed to make a withdrawal to roll that into another qualified plan that may have more options. It may provide you more control. So it is something that that we also review when we sit down with our clients, just to say if that is an option. Most retirement plans have some pretty good selections as it relates to investments, but if you are in a plan that there's very narrow selection, it could make sense to look at an in-service withdrawal. Again, that just allows you to go from your retirement account to another one that has just more options in it.
All right, thank you all so much for this. We are coming right up on 1 o'clock, and I want to be very conscientious of everyone's time. So WESCOM, is there any last things you'd like to say before we head off?
I would just want to say thank you everyone for joining in. I would like to take this time for David to announce gift card winners if we do have some, just so those who are still hanging on could find out if they won.
Yeah, if Karen Gracie is still on, please message me your email address, as well as Carlos Montoya. You guys both received a UCLA $100 store gift card, just to say thank you for your participation and being with us. So message me your email and I'll follow up with you.
Awesome.
Thank you for that. Thank you, David. And Joy, thank you for allowing us to participate and to present to your audience today. And again, if you're looking for more information, go to www.ucla.wescom.org and feel free to reach out to both Karl and DJ if you have any questions in regards to specifically to this presentation. If you have any general WESCOM questions, David and myself would love to answer those for you as well. We just want to say thank you for having us, and have a great afternoon. We'd love to do this again in the future. Thank you.
Excellent.
Thank you, everyone. Thank you, Joy.
And I will send a follow-up email to everyone that was here, as well as everyone who signed up for the Eventbrite but did not show up today, to give them a chance to get a copy of your slides. And then we can also put in a link to the WESCOM website and your email addresses so that they have that information easily available. Thanks again for a great presentation. This was really interesting.
Appreciate that, Joy.
Thanks.
Thank you.
All right, enjoy your afternoon, everyone.